Hi and welcome back. After the introduction in the first two videos on this theoretical course of commodity spread trading, we'll now start to learn and gain knowledge on the subject of spread trading, one of the best techniques to use in trading, offering the same levels of return and risk compared to alternate techniques. And this is something I'll explain numerically to you shortly. The name may sound a little complicated, but you'll see after some explanation and a couple of examples it's actually simpler than perhaps you first thought. I remind you now that we're covering things from a theoretical point of view, and in this video and the next we will look at the basics of spread trading. This second episode, like the first, is divided into two videos. Both build on the foundations of the introduction to commodities and will start to give you the knowledge you will need to learn and apply in respect to the technique of spread trading. So starting with the basics. In the first of the two videos we will look at futures, what they are, how to use them and the effect of leverage that comes from trading with them. Then we will move on to look at what an actual spread is before exploring the correlation between the various raw materials in respect to spread trading and how to profit from using them. So, looking into my crystal ball, it's time to move on and talk about futures, the financial tools that we use for our trading, or to be more precise, futures contracts. Futures are part of the derivatives family and are so called because their value derives from the reference to the stock with which they are linked. So in this case, the reference is linked to the stock of a raw material. Unlike stocks and shares that are issued directly from the companies producing the raw materials, futures are created directly from the market. What you need to know is a future accurately replicates the performance of a commodity. They can be bought and sold just like stocks and shares of the companies that produce them. But one of the things which differs from trading in stocks and shares is that a future has a maturity, an end date. We will see during this course that there are predetermined monthly maturities, so we know at what date we will have to close our future position. Now you can buy and sell them at any time, so you can get out of a position whenever you want. You don't always have to keep a future until its maturity. And it's most fortunate that brokers do not provide for physical delivery at maturity. That is to say, delivery of the raw material you've purchased a future on. I don't think my neighbours would be amused if I took home a truckload of corn or pigs or cattle. Brokers will tend to close a position off completely at the prevailing market price, probably whilst reminding us, as we've already mentioned, that the position can be closed at any time we decide to do so. It's important to know that futures create a leverage effect, i.e. they're able to move more capital than is actually invested. When you trade a futures contract, the price you pay or sell the future at will be directly based on the price of the underlying share. You do not, however, pay the full price of the share. Depending on what type of commodity you're trading, you'll be asked to pay a much smaller percentage of the price. This is referred to as a margin and is something that we'll cover later on. By paying a much smaller price, you can actually take a much larger position in the market or leverage your capital to better effect. It's important to understand this concept, and then together we'll begin to learn how to use the advantage of leverage in respect to our investments. So, now we know that we use futures to trade and that due to the leverage effect of using them, we can take larger positions in the market. But what exactly is a spread trade? Over the next few slides I will try to explain this in more detail. It's now time to look at the technique of spread trading, and in particular its application in respect of raw materials. But first, a quick definition. A spread is defined as the price or performance difference between two related financial assets. The key word in this definition is the term related. We need to look at how the raw materials we use are connected, and the term we use for this is correlation. So we've said we will only use futures that are related with a direct correlation in respect to the underlying products. In this example we see a chart showing the price for corn and Nasdaq futures, Nasdaq being an index made up of US technology stocks. These two have a highly uncorrelated performance because the underlying products are very different. One being a product that is grown and harvested, the other being made up of technology companies. It's easy to see there is no connection between the two, and therefore they would not be traded together. In this chart, however, we see that corn and wheat, both being part of the same agricultural sector, always maintain a correlated or related performance, or trend as it's known. As you can see, the trend lines, the upper blue and black ones, have moved in a similar direction over the 12 months shown. It's important to understand this. The underlying products need to be related. We would not trade a spread between cotton and oil. The two markets are very different. We could, however, trade a spread between oil and gasoline, given the type of raw material they are and the similarities between them. Or, for example, between corn and wheat. Again, two products with similar properties and therefore potentially similar performance. So knowing we need to trade a related commodity, let's look at how we actually trade a spread, and more importantly, how we could profit from doing so. As mentioned, the spread is the price or performance difference between two related financial assets. But what exactly is a spread trade? It means that I will buy one future, future X in this example, and sell another future, future Y, at the same time. The result of our trade will depend on how the X and Y future prices move. The formula is relatively simple. The spread price equals X minus Y, or the difference between the two futures prices. The action of trading the spread, buying one future and selling another, creates a covered position. Now hopefully you will spot an advantage of this. We will not be exposed to movement in one direction in the market. For example, if the market moves down, although we may make a loss on the future we've purchased, we'll benefit from the movement in respect to the future we sold. Therefore, we've reduced our risk. So how do we make a profit from a spread? Let's assume we've purchased future X and sold future Y. As I've just explained, we're not exposed to movement in a single direction in the market because one future is bought and the other is sold. The market will move, but what scenario will give us the best profit? If the price of future X rises and that of Y falls, the difference between the two will increase. This is the best possible solution and provides the greatest profit. If X and Y both rise, but the price increase in the X future is greater than that of the Y, we will gain profit as the difference between the two prices will increase. The same will happen to the spread price if both prices fall, but the price of Y decreases further than the price of X. This graph plots the trend for both futures. The red line is showing future X and the blue line is showing future Y. Given that we're talking spreads, we're not going to focus on an individual futures price. Instead, we're going to concentrate on the difference in price between the two contracts shown here by the green arrow. Typically, we would look to purchase this price differential and we would get a profit whenever the price difference between the two futures increases. I would say that although we always nearly purchase the difference between the two futures, there are occasions, depending on the market, when you can sell the difference between the two prices and still make a profit, when the distance between the two raw materials decreases, as seen in some parts of the graph. Whether looking to make a profit by benefiting from an increase in the price differential between the two futures, or as mentioned on some occasions by a decrease in the difference, it's important to understand the concept that a spread trade is the action of buying one future and selling the other. So now we've looked at the technical concepts of a spread. If something's not clear, if there's something you want to go over again, review this video as often as you want. It's important you understand the basics. Believe me when I say that when you put this knowledge into action, as always I would suggest you do this in a simulated environment first, it will be much easier than it may appear now. Looking forward to the next episode, we will continue to explore the basics of spread trading, where we will examine the types of spreads and the advantages and disadvantages of using them. As ever, I look forward to speaking to you soon. Bye for now.